Home prices are set to decline further this year as the Federal Reserve has yet to put the brakes on interest rate hikes. However, signs of peaking inflation could bring their monetary tightening to a halt and avert a full-blown collapse in the housing market. Today's video, we're going to be looking at the main factors impacting home prices over the last month, and I'll be providing my estimate on the most likely path for home prices going forward. Let's get into it. What I like to do in these housing scenario update videos is give you the answer up front, because these tend to be longer videos and not everyone wants to watch it through to the very end. But if you want to deep dive into all the latest data that has come in over the last month and how they affect the outlook, make sure to stick around until the end of the video. If you're new here, my name is Eric, and I am a professional private sector economist in addition to being a licensed real estate agent. So you get a unique perspective on this channel you'll be hard-pressed to find elsewhere on YouTube. At this time, I do like to give my usual disclaimer that nothing in this video is financial advice. I'm not a certified financial advisor or your personal real estate agent, and you are responsible for your own financial and investment decisions. All right, now that we have that out of the way, here's the high-level summary of where we are and what the most likely scenario for the housing market currently is. Inflation has shown signs of peaking, although it is too soon to know for sure, and the Federal Reserve, while reaffirming their commitment to raising interest rates to bring inflation down, appears unlikely to dramatically raise rates up to and past the rate of inflation to bring it down. This will all keep mortgage rates from surging too much further, and the latest housing data has confirmed we are in the beginning stages of a correction in home prices. My most likely scenario for the housing market has the Fed raising their Fed funds rate up to a range of 3.25% to 3.5% by the end of the year, which would likely push mortgage rates up to about 5.9% for a 30-year fixed rate mortgage, and the median national home price would fall by 11% from its recent peak in May through the end of the year. A more aggressive scenario, but less likely, would have the Fed raising their Fed funds rate by 75 basis points at each of their remaining 3 meetings this year, as they have done for the past 2 meetings, putting the Fed funds rate at a range of 4.5% to 4.75% by December. This would push mortgage rates to about 6.2%, and home prices would fall by 15% from the recent peak through the end of the year. I no longer see a full-blown market crash of 30% in home prices happening this year. The Fed just isn't going to raise rates fast enough for that to happen. So these are my latest scenarios of the likely paths for home prices right now. If you're one of those folks that just came for the high-level summary and will be leaving now, please leave this video a thumbs up. Share with others to support the channel and help it grow. And if you are not subscribed yet, I hope you will consider it, and also hit that notification bell down below so you know right away when my next video comes out. For everyone else who is sticking around to the end, let's get into the data. Although it's too soon to tell if inflation has peaked, we did get some good news on the inflation front for a change. The latest reading on the Consumer Price Index put consumer inflation at an 8.5% annual rate, down from the recent peak of 9.1% in June. While this may not look like much when you line it up with what's happening in producer inflation, it is actually quite encouraging. Since peaking at 11.7% back in March, the producer price index has shown clear signs of peaking and perhaps starting to trend lower. The latest reading came in at 9.7% for July, noticeably lower than the March peak. Producer prices eventually flow through the economy and impact consumer prices, and the combination of a potential peak in producer inflation being reached and seeing consumer inflation pull back a bit increasingly points to a peak in overall inflation. If these trends continue, it will definitely impact how the Federal Reserve responds with monetary policy. At their most recent policy meeting at the end of July, the Federal Reserve raised their Fed funds rate by 75 basis points, putting it in a targeted range of 2.25% to 2.5%. This was the second meeting in a row where they raised the Fed funds rate by 75 basis points. But what I thought was most telling was they did not go for a full 100 basis point increase. After all, the most recent reading on inflation before that meeting was the 9.1% peak seen in June. This tells me that they are not going to try to raise the Fed funds rate up to the level of inflation to bring it down. And here's what that means for the housing market. Mortgage rates are not going to go as high as they would need to in order to trigger a full crash of 30% in home prices. It's just not going to get there. 3.5% for the Fed funds rate by the end of the year seems to be the magic number right now, with the Fed then taking a pause to see how the tightened monetary conditions put downward pressure on inflation. With the target range at 2.25% to 2.5%, another 250 basis point increases would get them there. Given that inflation has pulled back a bit since their last meeting, a 75 basis point increase is less likely at their next meeting in September. Mortgage rates surged in the first half of 2022 as the Federal Reserve began raising rates after being near zero for almost 2 years. The average rate on the 30-year fixed-rate mortgage hit a peak of 5.8% in the week ending June 23rd, according to Freddie Mac. Since then, it has fallen to 5.55%. The initial surge to 5.8% seems to have been an overreaction by the market at the time, and rates are now settling down to where they are more in line with what the Fed has actually done so far. If the Fed continues raising their Fed funds rate to 3.5%, as is now widely expected, we're likely to see mortgage rates go back up to 5.9% for a 30-year fixed-rate mortgage. I'm going to be focusing more on the fixed-rate mortgage in today's update than the adjustable-rate mortgage that I highlighted in my last scenario update. As the 30-year fixed rate has been climbing, we also saw the adjustable-rate mortgages share of total mortgages rising. But now that the 30-year fixed rate has come back down, it seems to be back in favor as the adjustable-rate mortgage share has been coming down sharply, almost in lockstep with the trend for fixed-rate mortgages. This is not surprising, however, as adjustable-rate mortgages do carry higher risk, and some home buyers appear to be deciding that they are not worth the risk now that 30-year fixed rate has ticked down a bit. New housing data is in from Redfin, a national real estate brokerage, showing the decline in the national median home price continued in July, dropping to $408,000 from the $409,000 in June, putting it now 1% below the peak of $412,000 back in May. Just a quick note, you may notice that these numbers are slightly different than my last video covering Redfin's data release, but it's only due to the seasonal adjustment process that the data goes through. Some numbers get revised slightly. The takeaway, though, is that this is now the second consecutive month of declines for the national median home price, and it is likely the beginning of a larger downtrend we've been expecting for quite some time. From the latest housing demand data, we can see that this trend is only going to continue. The percent of homes seeing price drops has maintained its upward trend that started last year, and in similar fashion we're seeing increasingly less homes selling over list price as the sales to list price ratio reached 100.6 in July, the lowest it's been since March 2021. Home sales have plummeted as the July level is well below pre-pandemic averages, and pending sales shows the declines will continue. Add it all up, and what we have on our hands is a collapse in housing demand that is finally showing up in the national median home price. Sales have declined so fast that inventories are rising more and more. The month supply of homes, which measures how fast the existing inventory would be exhausted at the current pace of sales, has reached 2 months, the highest level since June of 2020. Now, with mortgage rates lower and home prices starting to decline, let's see what that does to affordability, which is, after all, the main component in my housing market scenarios to give us a sense of where home prices are heading. Plugging in the data on home price, mortgage rate, and household income, the average housing payment as a percent of income dropped slightly from 38.3% to 37.7%. As home prices come down and mortgage rates slow down from the market's slight overreaction in the first half of the year, I expect this affordability metric to return to levels more in line with historical trends. So that's where we are with all the data that has come in this past month. Now, let's get into some specifics about what that could mean to housing prices going forward. As usual, I have 3 scenarios that I work with in these update videos that play out the rest of the year. The baseline scenario, which is the most likely given where we are right now. The aggressive scenario, which ratchets things up a bit, but is not as likely. And then the full-blown housing market meltdown, where prices fall by at least 30% from its peak. Today, I'm not going to present that last scenario because it's just not going to happen by the end of 2022, as I mentioned earlier. There's no way the Federal Reserve is going to raise rates up to the rate of inflation, given what they've done at their last meeting. Inflation hit a new multi-decade record high in June, and that was the data available to them at their July meeting. And they didn't go beyond a 75 basis point increase, even with the labor market giving them the green light to do so. If they won't do it under those circumstances, I just don't see it happening at all. So that one is off the table. My baseline scenario is the one that gets the Fed funds rate up to a range of 3.25% to 3.5%, and they would get their raising by 50 basis points at their September and November meetings, and then leaving rates unchanged in December as they assess the impact of the monetary tightening they've done so far. Under that scenario, the mortgage rate would go up to 5.9%, and home prices, which are already down 1% from the peak in May, would fall by 11% through December 2022. For the aggressive scenario, I'm going to assume the Fed raises by 75 basis points at each of their 3 remaining meetings this year. That would put the Fed funds rate up to a range of 4.5% to 4.75%. Mortgage rates would reach 6.2%, and home prices would fall by a total of 15% from the peak in May through the end of the year. So these are the latest scenario projections I've run, and as you can see, we aren't likely to go anywhere near a full market crash of 30% drop in home prices anytime soon, more likely a 10 to 15% correction by December. Keep in mind that these are the likely scenarios I've come up with, and don't consider further aggregate demand destruction in them. That would happen in the case of something like a major economic recession, or if the Fed changes course and gets really aggressive. Supply is just too tight right now for anything but an epic collapse in demand to really crash prices. An event like a major economic recession is something that I'm tracking on my other channel, Papaya Cast, where I recently released a video covering the topic. A major recession would definitely impact housing demand, as we would see unemployment rise and incomes fall, making homes increasingly more unaffordable. I'll leave a link to that video in the description down below. The Papaya Cast channel was the first channel I started, and it focuses on forward-looking analysis for the overall economy, whereas here I focus primarily on the housing market. If you're interested in both topics, make sure you subscribe to both channels and hit that notification bell down below so you know right away when my next video comes out on either channel. I try to release these major update videos once per month, and I apologize for getting this one out later than usual this time around. Until my next housing scenario update video comes out, stay tuned for more regional analysis videos where I look at specific metropolitan areas that viewers have requested, like the most recent New Jersey and Raleigh, North Carolina videos, as well as some of the major markets across the nation like Austin, Texas, and Phoenix, Arizona. If you like this video, please leave a thumbs up to support the channel and help it grow. Thanks for stopping by, and I'll see you in the next video.